Index funds, mutual funds, ETFs, stock market indexes, bond market indexes. What am I supposed to invest in? When I started investing myself, I had a hard time to fully grasp the differences and actual meanings behind these terms. There are many useful and great videos here on YouTube, but to be honest, most of them have a lot of inaccuracies. So let's start with index funds. In order to explain what an index fund is, I need to explain another concept: index. What is an index? In economics and finance, an index is an indicator or a benchmark that tracks something. There are many kinds of indexes. Stock market indexes, which are the most famous ones. You probably heard of the S&P 500, the Dow Jones Industrial Average, Nasdaq Composite, etc. Then we have bond market indexes, commodities indexes, derivatives indexes, and many other types of indexes created to measure other financial or economic data, such as interest rates, inflation, or manufacturing output. In the context of investing in index funds, we are gonna consider indexes that are investable and transparent, like stock market indexes. So let's take as an example of an index the S&P 500. This is an index that tracks the performance of 500 large companies listed on the stock exchanges in the United States. It uses some formula to take a certain percent of every company according to the market cap. So for example, as I am making this video, the S&P 500 is worth roughly $4,000. It is kinda volatile in this period. Cool, but how is this number useful? Well, you may want to compare it with the past. You may compare its trend to other indexes, and you may consider that it may keep growing in the future. As you can see, over time, the S&P 500 steadily and gradually keeps growing. It may go down sometimes, stay steady, but over the long time, it keeps going up. As the United States economy and GDP keeps growing, so does the S&P 500. This is interesting, because when you invest in a company, there is always a certain risk. But in this example, with this index, it seems pretty safe over the long run. So if you could invest in this index, you will own a broad spectrum of stocks and be pretty safe. I mean, in order for this index to fall, the United States economy should fall, which is not something impossible, but definitely less risky than a specific company failing. But there's a problem. You cannot invest in an index, as an index is just some indicator calculated on paper. And that's why, in 1975, John Bogle, the founder of Vanguard, introduced the first index fund, which indeed tracked and still tracks the S&P 500. And after that, so many different types of index funds started being created and introduced from many different companies. So here we are. I introduced the concept of index. Now you have the concept of index fund. An index fund is indeed a fund, so a pool of money invested by someone in a way to replicate a certain index which tracks investable assets, in most cases stocks. Basically, imagine me and another million people put in a certain amount of money, then a manager takes this pool of money and starts buying shares in the companies to replicate the index. Good, so now you know what an index and an index fund are. Now I am going to add that there are two types of index funds: mutual funds and ETFs, which stands for Exchange Traded Fund. What are the differences? Mutual funds are funds, so again, pools of money, managed by someone. Not all mutual funds are index funds. Just when a mutual fund tracks an index, then it is an index fund. We may refer to this as an index mutual fund, otherwise it is not. Index mutual funds follow a passive strategy. The manager of the fund simply tries to replicate the index which the fund is designed to replicate, but he is still there to make sure the fund doesn't stray from the target index. But typically mutual funds are actively managed funds, meaning that the manager of the fund is not trying to passively replicate any index. They are usually trying to beat the market by actively choosing which stocks to buy or sell. An example of a famous actively managed mutual fund is the Fidelity Magellan Fund, which for a period used to be managed by the famous investor Peter Lynch. ETFs, which again stands for Exchange Traded Funds, are as well funds, so pool of money. Just like mutual funds, ETFs as well are not just index funds. You may have some ETFs that try to track some indexes, which are indeed index funds. We may refer to these as index ETFs. But you may also have some other types of ETFs, which don't track indexes. For example, you can have ETFs that tracks prices of commodities, like gold, silver, wheat, etc. So with those ETFs, you're not diversifying or investing in a broad spectrum of assets, but just in one specific thing. You can also have actively managed ETFs. For example, some famous ones are ARK Invest ETFs, managed by Cathie Wood. So let's recap. You have indexes, then you have funds that track these indexes, so index funds, and you have two types of index funds, mutual funds and ETFs, which, since they track index funds, have a passive strategy. Then you have actively managed mutual funds and actively managed ETFs. So let's get to our final point. What's the difference between mutual funds and ETFs? I'm going to repeat again what they have in common first. They are both funds, so again, pools of money, managed by someone and invested in a certain way. I will say that the first and main difference is that ETFs can be purchased and sold like if they were stocks. You can buy and sell shares of ETFs as the market is open on your brokerage account. On the other hand, mutual funds can be traded just once a day. The price will be the same for all the people who put an order that day, and it is calculated just at the end of the trading day. The second difference is that you can purchase a mutual fund just directly from the fund provider itself. The third difference is that typically for a mutual fund, an initial capital invested is required, which could be of around a few $1,000s, while with ETFs you could buy it as a stock, and the price can vary from like $50 to a few hundreds, depending on the ETFs. The fourth difference is that with mutual funds, you can set a certain amount of money to be regularly invested, like once a month, without you doing anything, directly from your bank account. This is something that normally you cannot do with ETFs, but still, there are some brokers that have functions that allow you to do that. Difference number 5 is that in most cases, mutual funds are actively managed. So most mutual funds are not index funds, while typically ETFs are passive funds. Typically, they are not actively managed. And the sixth difference is that typically mutual funds have higher fees compared to ETFs. But that's not always the truth. It depends mostly if we are talking about actively managed funds or passively managed ones, so index funds. We can say that generally, actively managed mutual funds are more expensive than actively managed ETFs, which have higher fees compared to index mutual funds, which, again, are more expensive than index ETFs. But of course, it's not always the case. So now that you know the main differences between these different investment vehicles, you just need to decide your style of investment and the best products for you. See you on the next one. Bye!